We have the difference between an enduring bull market, that's gold. Right now, it's at, if you end the month now, it's at a record high, and an enduring bear market, that's crude oil. The price in the screen you see right now, WTI, $74 a barrel, about there, was first traded in 2006. That's almost 20 years ago. And as we tilt towards this easing cycle, typically that spread with gold outperforming crude oil widens, and it looks like it's just getting started.
First of all, you buried the lead. We're not coming to Miami, Mike, so you can stop looking for fun things for us to do. You can not worry about your guest rooms. Like, we're good. So the record high, though, that we saw back in gold that we keep hitting here, I'm really struggling as to what is actually leading it, because the last 10 years when we had low rates and all that, gold did a whole lot of nothing. And it has just been feeling like a nonstop tear in the last few years.
Yeah, let's start with two things. The unstoppable rise in U.S. debt to GDP, the very expensive U.S. stock market, the Federal Reserve tilting towards easing, and the most significant elephant in the room is the unlimited friendship between President Xi and President Putin. That shifted the world order in favor of gold, and it looks like it's accelerating. So the biggest, deepest pockets on the planet, i.e. starting with China, have been buying the metal. And it looks like once we get a little bit of reversion in lower yields, i.e. T-bills not at 5% anymore, and maybe just a little back and fill in the stock market, gold will shine. It looks like it's continuing to do that. Now, right now, it's a little bit overdone. Managed money net positions, i.e. futures, are really long for a reason. It's a bull market. But the narrative for gold is quite strong. And I'll just end with this. Gold is historically very cheap versus S&P 500. If you just take it divided by the ounces divided by the index, particularly when you enter recessions. What oftentimes happens when you enter recession, the Fed eases, that spread just kind of narrows a little bit.
What would change this? It seems to be a structural bullish call on gold, Mike.
Yeah.
What would need to change that?
I think the first thing is the U.S. stock market to stay resilient. Well, why buy gold when it's that resilient? The most significant thing was some kind of unexpected détente, i.e. President Xi picking up the phone saying, yeah, we're done with this unlimited friendship. The détente that's happening globally is part of what's really driving gold, i.e. somewhat getting away from the dollar, looking for an alternative to U.S. Treasuries, particularly with yields dropping and the debt to GDP just continuing to rise. So that, to me, would be one of the most significant things. Otherwise, it looks to me, once we get a bit of reversion lower in the stock market, which at some point will happen, gold will probably shine like long bonds. Like on the month now, on the quarter now, gold's up about 8%. The U.S. Treasury, the Bloomberg 20-plus long bond index is up about the same, about 8%.
What about positioning at this point? Like, I know the central banks are buyers, et cetera, and that and price spikes, you're not going to see a lot of physical buying also, et cetera. But who's left to buy in the futures market?
That's a key thing, Alex. A good point. About 44% of total COMEX futures positions are speculative longs. That's very high. The high really gets much higher than 48. But what's really happening is we've had significant outflows in gold ETFs since that peak in 2020. They're just starting to turn to inflows. And I think that is part of that alternative you see with people going to cash and bonds. They're looking for alternatives to the expensive stock market. So that looks like it's just rolling over. But if you got a day like we had on August 5th when markets go down, yeah, you sell what you can. And there's a lot of speculative longs in gold at the moment for a good reason, though. It's a bull market.